The Centaur Flexible Fund has averaged returns of 19.3% per annum since inception, and that's comfortably trumping its benchmark by 4% per annum. The fund notes that despite some of the challenges facing the economy, in the short term at least, prospects should be good as we head into Christmas. But for the long haul, the fund has been finding more attractive value overseas. Here to share his views with us, Roger Williams, the Managing Director of Centaur Asset Management. Roger, thanks very much for your time. Let's start with that offshore theme and where in particular you are finding value at the moment.
Where I've actually found value is in Europe. In Germany particularly, you've got very well managed companies which are multinationals, often on single-digit PEs. For example, Volkswagen, it's a cyclical industry, but it's really been taking market share from everyone, producing unbelievable cars, and they've really got a suite of different products, different brands, and on a PE of about 6.5, that looks pretty good value. And there are other opportunities. For example, I've bought a French media and telecommunications company on a PE of about 7.5 called Vivendi, also with a 7% yield, and what's exciting there is there's corporate action. Someone's come in and really looking to break up the company, and that could really give very, very good returns in the breakup.
Roger, I'm just fascinated to find out, when you say 7.5 PE, 7 times PE, as far as I understand in Europe, you can, on a normal level, those companies trade at twice that, twice to maybe even more that. So usually at a 15 to 16 times price earnings multiple. What you're telling me is you can buy these companies at a 50% discount, in other words.
Yeah, listen, I don't think it's all. I don't think most companies on 15, 16 Ps. The more quality companies, let's say like SAP, which has grown earnings consistently over the long term, is more on a 15, 16 times PE, or L'Oreal, Unilever, the more low risk, non-cyclical businesses. Maybe the ones which are growing slower on much lower PEs.
Another thing that we've been speaking about extensively on the show is avoiding value traps.
Yes.
Now, how do you ensure that none of these well-placed, valued, or companies that look as though they're offering value right now stay away from becoming or aren't value traps?
Yeah, listen, I think that is a big problem, because a lot of these things, they look cheap, but because they're never growing earnings, and the PE never expands, their returns are just remaining poor and sometimes get cheaper. So I look for companies with a catalyst generally. So Vivendi, for example, I think it is in maybe some of its components are in a difficult space, but it's more a breakup situation where...
So the corporate action is your catalyst?
The corporate action is the catalyst to unlock value. There are other things which should get earnings growing, but it is a very, very difficult environment in Europe, and there really isn't much growth. For example, Volkswagen, another theme I've really been investing in is I think the winners are going to continue to win. I think that's across the world and includes South Africa in particular, because what has happened is the companies which are gaining market share, they've set up a business model which can really win customers. And that's not 1 year of progress. It's often a whole back end of 10 years of investment in their product, in the infrastructure, in acquiring customers, and now the fruits are manifesting in superior growth numbers.
So, Roger, we talk about some great winners locally. We talk about the likes of Capitec, Cashbuild, Mr.
Yes.
Price. They've come into the markets and changed the industries in which they've operated in.
Yes.
Is it even worth looking at the financials to try and get a sense of value? Because you're actually buying the concept more than you are buying the past performance, so to speak. I mean, if you looked at Capitec in 2001 or Mr. Price in 2001, there wouldn't be much reason from a financial perspective to see value in the share. But if you believe that, in this theory of yours that they've built a business model that can continue to win, then obviously it's quite different. How do you sort of sum up the winners? Because often it's not offering value. It might be quite expensive by many measures.
I mean, that is the hardest thing. I try to buy winners at a reasonable price, and that's not always available. I think, Capitec in hindsight is an unbelievable winner, which I have to admit I missed, and I actually looked at it in 2001 because it was a very small company. But Mr. Price has been a good company for probably 15 years. I think in 2001 it already was a winning company with a great niche. and had lots of growth potential. So there you could have kind of picked it up. In 2008, it actually fell to a single-digit PE, great entry level, and subsequently it's performed. So you really have to buy these at the right time, and often there's momentum which continues to go. For example, ShopRite was on a single-digit PE in 2003. Prior to that, it already had a track record of 20 years of 20% plus earnings growth. So if you can find a winner which is really on the right path and really is not saturated, those are the things to get into. It's a very, very hard call.
But the key is to find a cheaply priced winner.
Yeah, which is very, very difficult. I think what's happened in this market, the market's really paying up for growth. So it's hard to balance the growth and the value. For example, ShopRite's on a historic P of almost 30 times. There's not much margin of safety, and its core business in South Africa, the margin's exceptionally high. It's 6%. It used to be 2%. So you can see it really has to deliver. And Africa, even though I think it will be very, very successful for them, is a small component of their business still.
Another theme that I want to touch on is the rand. And
yes.
Long term, you are looking for weakness, which is beneficial to exporters. Yeah. We've just spoken to Chris Hart, who feels that with the Democrats now back in play for a second term, we're going to see a quantitative easing being the order of the day. The dollar is going to come under pressure, and that may be some reprieve for the local unit. You don't think that will flow through? Listen,
I think in the short term the rand could strengthen. I think it is slightly oversold, really, because all of the concern about strikes and that. My original rand call was when the rand dollar was 670. That's when I moved money out within my fund. I'd say it's probably fairly valued at about 870. But, that really favors things like Sasol. I don't think the market's discounting an 875 rand. They're looking more at an 8 rand to the dollar in their forecasts. And as that unwinds over the next 2 years, I think Sasol's earnings should outperform expectations, and consequently Sasol too. So the terms of trade have improved slightly more towards exporters. So I'm looking to put in a greater bias towards exporters. Also, we've got a very high current account deficit, which I can't really see that declining materially. I think it's about over 6%. Maybe it goes down to 4%, but I can't see that being eliminated. I think the platinum industry is under extreme pressure. And there's always a risk that risk aversion comes back into the market. And there's asymmetry with the rand. It could go to 11, but I can't see it sustainably being at 750 for any long period.
Roger, you haven't mentioned the resource counters apart from there briefly. Yeah. What's your take there? Is this a value trap at this point, or is there a distinction between different commodities, or how do you view this very large chunk of our market?
Yeah, I think resources are largely value traps. The deep level miners, gold and platinum, they've got a big problem because their costs are continually escalating way above inflation. I looked at Lonmin. I think over the last 10 years, their cost per ounce has been going up at about 14%. And that's a problem throughout the industry. And really, the government hasn't been sympathetic to their plight, increasing electricity prices at very high rates. And this has really undermined their competitiveness. Platinum, a lot of people are very positive. I'm not. I've done the work. I just can't get positive. The reason why is recycling is really introducing massive new supply. And also the demand is not that strong. So platinum, I know people are saying, listen, implats are great value, but implats is still 100 billion market cap, and I just can't see great value.
Will recycling impact the autocat environment, though? Because I think that's where people are positive about the platinum story, is that when we see economic growth globally coming back on full steam,
yes,
cars are not going to disappear. And obviously key to that story is the catalytic converter.
Yeah, what's happening is the catalytic converters from 10 years ago, which often had a higher platinum loading than current catalysts, are being recycled, and that's about 30% of autocat demand. And America's very efficient in the recycling of auto catalysts, but the rest of the world is really behind them. As they come closer, the efficiency levels of of America that could introduce more supply coming from recycling. So the net demand is actually not so strong, and really to expect Europe to suddenly start, car sales to turn around and boost demand, I think that is really being optimistic.
Roger, as you say, you've done the research, and I'm going to use that argument with the platinum bulls out there, especially when they say you should buy Anglo Platinum or Impala Platinum. Warren, anything from your side?
Absolutely. I'm just interested, are there not companies that specialize in recycling that you're buying overseas?
And I haven't actually looked into that.
There could be a gap in the market to set up that business. Perhaps we've put it out to the entrepreneurs out there.